Welcome to the Pacific Research Institute's Next Round podcast. I'm Rowena Itchon, COO, and with me, as always, is Tim Anaya, Vice President of Marketing and Communications. So we have a special guest this week, former SEC Commissioner Paul Atkins, to discuss this trend, the rise in ESG or environmental, social, and governance investing. And, Tim, when I was in the money management business, I wasn't a money manager, but a spokesperson for a couple of prominent money management firms. ESG was just a very small segment of the market, and it was geared to mostly investors who wanted to invest in companies that fit their ideals or their philosophy. So, for example, some mutual funds stayed away from tobacco companies. Others focused on companies that were socially responsible and gave a lot of money away to charity and various causes. Now ESG is becoming widespread.
It is troubling to see, and certainly as we have documented at PRI and the great work by our Dr. Wayne Weingarten, ESG is going from something that is certainly of concern for anyone who has a public pension, that state pension funds are investing based on ESG principles and not what's in the best interest of retirees or taxpayers. And ultimately, taxpayers get stuck holding the bill when the pension fund returns don't come in at a great enough clip to fund retirement payments for our state retirees. There's all sorts of proposed SEC governance rules that we'll get into a little bit that Wayne has written about that requires all sorts of information and annual disclosure statements. You're even seeing pushes by activists and even in Europe, some governments where they don't want you to have a bank account if you're a non-politically correct industry. That's very troubling. So I thought it was a very interesting discussion that builds upon, the work that we have done over the years. But, it kind of makes you wonder, where are we headed with this? Where are we going on ESG? When is enough? And we're really kind of taking the desires of people who want to support environmental causes with their investing, and we're really translating it into we're imposing our investing values on everybody else.
The heart of the problem is that this type of investment practice automatically assumes that it's what all investors want. And this is especially problematic, as you point out, that most investors really want to maximize their returns based on their risk tolerance. And fund managers are starting to stray from that and not necessarily maximizing returns, but following this agenda of supposedly doing well and doing good. And the problem is that doing good is not necessarily from the perspective of the investor, but from the perspective of the money manager, especially some of these giant mutual fund companies. ESG labeled funds, as Wayne had pointed out, can charge more, up to 40% more for management fees. So who is really doing well here? It seems like the fund companies are to me. And what is the meaning of good? Well, Wayne also points out that while these companies focus on so-called clean energy and clean companies, they still are happy to invest in companies that are in totalitarian regimes like Russia and China, who systematically jail and kill their own people who dare oppose them. So, are these funds really doing good? So we're lucky to have Paul Atkins with us. And ESG, as you say, is now starting to permeate so many aspects of our lives, from the funds we invest in for retirement and even in our own government, where the overreach of the administrative state wants to promulgate regulations and requirements on ESG investing. So we're happy to have Paul to unpack all of this for us. But before then, we've got a few announcements.
Well, if you are interested in these issues and you want to have an even deeper dive into all of these issues about ESG and government kind of controlling your personal well-being and your ability to invest as you wish, then join us this upcoming Wednesday at 11 a.m. Pacific time for our special webinar with New York Times bestselling author Carol Roth. She has a terrific new book out called You Will Own Nothing that explores all of these issues and more. And she's going to be in conversation with our Dr. Wayne Weingarten. We're going to talk about these sorts of issues like ESG and cryptocurrency and all these other things. And we just learned that Carol's new book is also on the New York Times bestselling list. So if you want to hear the author, one of the hottest books in the country today, join us Wednesday at 11 a.m. and you can go to pacificresearch.org/events to register.
Thanks, Tim, for that. And one more announcement for our Southern California supporters. We wanted to let you know that we've got a terrific guest, John Yu. John is a law professor at UC Berkeley, and many of us know him as a Fox News contributor on Supreme Court matters and other legal issues. And going back further, he was a Justice Department official who wrote the waterboarding memos as Deputy Assistant Attorney General. His new book is The Politically Incorrect Guide to the Supreme Court, part of Regnery Publishing's Politically Incorrect Guide series. The luncheon is at the Pacific Club in Newport Beach, August 15th. He's a terrific speaker, and again, we're lucky to have him. So thanks everyone for listening, and we'll get to the podcast. Here's Paul Atkins. Welcome to PRI's Next Round podcast, Paul.
Well, thank you very much, Rowena. It's a pleasure to be here with you.
So you and I met when we were at the Securities and Exchange Commission back in the early 90s. You were special counsel to Chairman Breeden, Richard Breeden at the time, and I was his speechwriter. This topic of ESG, environment, social, and governance, was still in its nascent stages back then. And there was some of it, but I think it was generally recognized and respected as an investment option for investors with a particular philosophy, not something that was forced on everyone as we're seeing more and more today. So let's start off with a big picture question. How do you think it's become so widespread? How did we get here?
Well, that's a great point. And thanks, Rowena, for reminding me about memory lane, going back to the early 90s there, when things were a lot different in the marketplace than they are right now. So, for example, if you think back there, 30 years ago or so, individual shareholders as a force in the stock market, in the securities markets, constituted about 50% of the holdings. And if you go back 50 years ago, they were 80% of the holdings, of the listed securities. And today, though, it's completely flipped. Institutions, meaning, say, mutual funds, pension funds, insurance companies, universities, and whatnot, they hold about 70% of the total market cap in the United States. And individuals are down to somewhere around 30%. And this means individuals owning directly, not necessarily through other things like mutual funds. So because of that flip, you now have other people managing money than the real owners. And so it's more efficient for shareholders and investors to do it that way. And we've had the growth of ETFs, exchange traded funds, and all sorts of other vehicles that have attracted individuals, index funds, and all of that. So because you have these professional managers managing things, that it gets away from what the real investor may want to do with his or her money. And so institutions then have their own proclivities and their own ways of doing things. And so that's one way that ESG as a concept has gained a lot of traction because of the attractiveness for various institutions and the forces that propel them, meaning they're big investors, the people whom they consider to be their top clients, and all of that. So, and ESG has been around as a concept. It's kind of an odd grab bag because it stands for environmental, social, and governance. And so governance has always been a factor when usually when an investor considers a company and how will it's run, meaning, is this like a piggy bank for the CEO to, pay for his, beach houses and airplanes, or, how's the board doing and overseeing things and advising of the company, and how does the company run its business and affairs. And then you lump that in with social issues, which that varies, as we've seen in the last 2 or 3 years. It's changed a lot in terms of, what is, at the top of the agenda there. And if you go back certainly 30 years or more, it'd be something totally different. And then finally, the environmental issues have also changed, over the last several years. So it's kind of an odd grab bag, but the origins of it were back in the, say, the 1960s and 70s with the growth of the whole corporate social responsibility movement. And then the United Nations with another acronym, PRI stands, of course, for Pacific Research Institute, but for our purposes here, it's the UN Principles for Responsible Investment, PRI. And so that's then developed more into sort of this ESG concept.
A recent story in Yahoo Finance reported that July is ESG month in the halls of Congress. So obviously the issue is a hot one in Washington. In a March survey earlier this year from Quinnipiac, 68% of Americans said that they're worried that they won't have enough money for retirement. But money managers, especially the large ones, seem more concerned about an ESG agenda than increasing shareholder returns. Now, I know there's a move among some Republicans to try to increase transparency and oversight to be sure the practices of money managers are aligned with the interests of individual investors. Can you give us your thoughts on this?
Well, that's pretty much the crux right now of the whole debate around ESG is, as I was talking about, the professional money managers, the big institutional investment managers who are managing other people's money. How are they managing other people's money? And if you're that other person whose money's being managed, who is deciding, for example, you own stock in company X and there are shareholder proposals that need to be voted on or acquisitions that need to be voted on, tender offers and whatnot. How is your money being managed and put to use, and is that the way? Do you agree with that? What's interesting is the way demographically various investors are not monolithic, shareholders are not monolithic, all of us are different and carry different concerns. And if you look at the demographics, say for the baby boomers are certainly very concerned with retirement and with potential medical issues and old age issues, and maybe they are trying to care for their parents or put kids through college and all of that stuff. So usually when you're in that age bracket, you definitely care about returns, you care about preservation of capital and growth, and so you don't really want to have your money be spent on a lark or something that is not normally in the bullseye of your target zone. So that actually plays out when you look at the various surveys that are done by, you mentioned the Quinnipiac study and others. Stanford University has done one as well, looking at millennials and Gen Zers. So these are the younger folks, 30 years or so and under. They are all for, they at least a large portion of them are supportive of investing according to things other than returns. At least they say they are, and so they versus as I was mentioning, say baby boomers who are more concerned about those returns. I think there's many money managers have been trying to be accommodating to these various targets of groups, but the charges are, and what has made this kind of more of a political issue is the way that various special interest groups that have special axes to grind have discovered that pressuring institutional investors and corporations, their boards and their management through shareholder proposals is a very inexpensive and thus cost-effective way of trying to change behavior towards the goals that these various groups have. And the person who kind of pioneered that type of strategy was none other than Saul Alinsky. And so if you look at his book, Rules for Radicals, in the penultimate chapter, it's called Project Proxy. And so he was from Rochester, where Eastman Kodak, for those of us of a certain age, we remember Kodak cameras and film. And so that the headquarters was in Rochester, New York. And so Saul Alinsky discovered how, with just a postage stamp and mailing in a shareholder proposal, he could get a lot of attention from management and shareholders, because his proposal would be published, in the proxy statement, and shareholders would have to read it and consider it, and there would be a statement in support of that he put in support of the way he would hope the thing would be voted on, and the board would have to pay attention and come up with the board's recommendation, and usually it would be in opposition to that. So that was all free advertising, and boards and management would tend not to want these things on the proxy statement, so they would negotiate with Alinsky. And he figured out, wow, I have a lot of clout now, and who knew that I could basically take this corporate governance mechanism and use it to my benefit. And so that actually has now been replicated, and there are a lot of other changes in the markets. Like I mentioned earlier, how now more institutions control about 70% of the market cap in the United States. So they are beset by a lot of these special pleas from various interest groups. And so they have to figure out, how do we vote these proxies? So they tend to farm out decision-making to a duopoly of what's called proxy advisory firms, ISS and Glass Lewis. And so those two firms have a lot of clout in this particular area. And they tend to, so you can see the patterns that develop in the voting of these various issues. And then so that sways companies in various in directions of some of these people who are advancing these various propositions. So that then has generated a backlash in many states, and what many people call the red states, where Republicans are in charge of state governments and also the state pension funds. And so they've awoken to the issue of, how are the interests of their pensioners and their states being advanced or undermined by the votes of money managers. So they have started to hold money managers to account. Like, why are you voting? If, say, for Texas has famously asked this, we're an oil and gas state. A huge percentage of our population, our economy depends on oil and gas. And so why are you voting in favor of propositions, say, to big oil companies? For example, Exxon, a couple years ago, there was a short slate of directors that was put forth by a small hedge fund that actually, just cleared 50%. And so the short slate directors were, put on the board, and that created a huge consternation among many of these oil and gas related states that, our funds are being voted, what in their view against the interests of the people and the economy of the various states. So that's kind of the crux right now of the political issues. And so thus there have been lots of what are called anti-ESG bills that in the last couple of years have been proposed and actually enacted in some of the states. So it's created a lot of controversy.
So another area that's in need of reform is how ESG is defined by the rating agencies. There's very little accountability and transparency in these so-called ESG scorecards. So how green is a green company often depends on the eye of the beholder, and in this case, the ESG rating agency. So what can be done to give the individual investor some safeguards should they rely on these agencies?
Well, so that's a great question. And there's been a lot of discussion on that side as well. The SEC, in fact, has, it was colloquially called their names rule that they are debating and have out for as a proposal to, to address some of these issues. And there's a controversy around how effectively, it will do that, or whether it's overreaching and creating more problems in the way it's structured. But, ESG, like I said at the beginning, is kind of an odd mixture when you put, environmental issues together with social issues. And both of those two terms are, really, really broad. And then you marry that with governance, which is, a much different topic. So you start off from a very kind of squishy base to begin with. And so who's to say what is really an ESG fund? And so then you have, so those three prongs that go into it, are addressed by the people who give different weights to them. And so you have just a multiplicity of groups out there who have their scorecards. And so that tends to drive corporations crazy, because questions are being sent in from various of these firms asking, for information. And so companies have tried to respond to that by coming up with ESG reports or sustainability reports. Most S&P 500 companies do something in that way, one way or another. That has created a lot of paperwork, but then also inevitably more questions from these various investor groups out there who are trying to run their ESG funds. And the people who are running these funds, it's in their interest to have as much information out there as possible along these lines. But a corporation, its main goal is to focus on shareholders and returns for shareholders. That's the basis of our American way of corporate governance. So there's a lot of money that's being spent on these various on producing information. And now the SEC has come out with a huge proposal that stretches for hundreds of pages for requirements for companies to produce information around, and it's incredibly, I'd say, nitpicky in the information that's being required. Very little of it, if any, is material, and that's a term of art by lawyers in the securities field, meaning that if there's a piece of information, this is defined by the Supreme Court basically from a case about 50 or so years old, but basically it's information that is of such importance that it can, basically the idea is that it would sway the value of a stock in the market. And so little of the ESG type of information really would fit that. And so when you look at all these various ESG funds that are competing with each other to try to gain investors and whatnot, it's I guess the subtitle is here, what a difference a few years make. So if you look back at, say, 2017, 18, 19, when ESG was becoming more of a hot topic, ESG funds, so-called, had a really good return, because what were they doing? They were way overweight in technology stocks and things like that, underweighted in oil and gas. And so with energy prices at real historic lows and technology stocks really zooming because of all sorts of things going on on the technology side, those funds were riding high. But then came COVID, and then you had the Ukraine war and the run up in energy prices, and suddenly everything's flipped. So now these ESG funds for the past 5 years have underperformed the market by something like 2.5% per year, and And so this this has lent weight to folks who are saying, well, ESG investing is not necessarily the best strategy. And Bloomberg, for example, pointed out it last year in 2022, 8 out of the 10 largest ESG funds had double-digit losses and underperformed the S&P 500 index. So, it's an issue that rings home to investors as well who are trying to decide where to put their.
So you mentioned about the SEC. This year they're expected to publish their own climate-related disclosures for public companies. So taking kind of a broader look at it, do you think this is ultimately an overreach? And if so, what can Congress do, if anything, about it?
Well, so I do think it's an overreach. So some former commissioners of the SEC and I signed a letter pointing out all the ways that I think it is deficient in the principles it's articulating. How it exceeds authority of the SEC, and I think will likely, if it goes through the courts, I think the way it has been proposed will, it will not be successful and will fail in the courts because of all those reasons. But the proposal, I think will be challenged on, various grounds. Like it certainly lacks statutory authority because the disclosure rules that it's put forth are really beyond the scope of what the SEC does. The Supreme Court came out with a really seminal decision last year called West Virginia versus EPA. And in it, the Supreme Court just said, you can't take some obscure, section of a statute that was passed decades ago and then suddenly find newfound authority there to completely remake the economy. And arguably what this SEC rule will do is just that. I mean, it will completely skew the financial statements of public companies, making it really revolve around climate disclosure. And that, and so, which is one of the current commissioners, Hester Peirce, said, if this goes through, that you'll have to rename the Securities and Exchange Commission into the Securities and Environmental Commission, which is, I think, a pretty a good tongue-in-cheek comment. But so anyway, so I think, it certainly exceeds SEC's authority. They deal with major questions of climate policy, which, really should be left to Congress. It's compelling corporate speech, which has First Amendment implications. And, it's just many of the lines that are drawn throughout this whole proposal are basically arbitrary and in nature. And so that's going to have, I think, trouble under the the statutes that guide the principles that guide agencies and how they promulgate rules. So for all of those things, the huge costs that these rules will impose on companies and basically investors, the complexity and all of that. If you think that now it's hard to get through a 10K or a proxy statement to understand what's going on with a public company, just wait until they have to now, according to this proposal, for example, disclose the zip codes of where the power plants of a electrical company are, things like that, for the various purposes of the rules. So it's the complexity and the detail is really pretty shocking. So you asked what Congress can do about it. Well, Congress is rather divided now. So they are doing hearings on these issues, especially in the House of Representatives. They're sending letters to the SEC demanding information. There is a statute called the Congressional Review Act that allows Congress for major rulemakings, and this certainly would count as one, to vote on them. But presumably, the way Congress is set up now, I don't think they'll reach an agreement between the two houses or even within the two houses as to how to approach and how to review the whatever rule comes out. So there's, without more of a consensus in Congress, there would be, I think little that they can do. But the one thing is the courts, of course, are the final arbiter of constitutionality of rules and of statutes, and I think that based on current precedent, a rule of this magnitude is not going to survive. But we'll see.
So, Paul, let's turn from Wall Street to Main Street. The culture wars in this country have now moved into corporations and their role in promoting social and environmental responsibility. So, headlighting these issues in recent weeks has been Anheuser-Busch and Disneyland, both companies experiencing actually a backlash from customers. For corporate executives who've strayed from their responsibility of increasing shareholder value, is the free market and public opinion working, or does more have to be done?
Well, I think, there's a lot to be said, obviously, for the free market to really take over. And I think when you look at how, over the last, several decades that, the environmental, so that environmental problems have being addressed by the private sector and have created ways that have helped clean up a lot of problems that were kind of intractable, even for government to solve. And as we've seen, in many cases, it was the government itself that was the one that causes problems. And just looking at New York Harbor and untreated sewage going into the harbor, and maybe still in some cases still is, things like that are. Whereas in the private sector, and some of this is because of the environmental laws that have forced companies to clean things up and not kind of foist extraneous costs on other people downstream, so to speak, from them. So that has certainly created a different environment, excuse the pun. And then also with the private litigation, of course, that's also been a big incentive for companies to clean up their act, and so I think the public has been a beneficiary of that, and we can let others argue about the costs and the benefits of that. But certainly the marketplace has done probably, I would argue, more than any. If we look at this SEC proposal, and the breathtaking complexity and overreach of this proposal, I don't see that that's going to really create a lot of benefits for people. Now, when you're talking about Anheuser-Busch or Disney, it's the customers and the various states where these companies operate. They have to be cognizant of both of those elements. And so we've seen on the left and on the right, the both customers and states weigh in. And so I think companies have to be very careful about how they walk that tightrope and stay balanced. So that's the very interesting situation, but I think it's the free market is a better way to address these issues than through government fiat.
So many states have proposed or adopted state-based legislation limiting the ability of state government, including public retirement plans, to do business with entities that don't do business with industries that have ESG goals, or companies that consider factors in their ESG factors in their investment processes. Florida, however, is one state that would restrict ESG activities using state assets. But our home state of California, of course, is going the other way. It's poised to pass its own law that would mandate climate reporting. Now, this can't be good for the state, which has seen hundreds of companies move out in recent years. What do you think is the long-term impact of these types of policy changes?
Well, I think it's just too bad that these sorts of things have become politicized, and because again, we should be looking at, the shareholders of these companies who are invested in them, and they're looking for returns. They're looking for, to save for their retirement, for education, for healthcare, and all of that. And so the distractions and the extra costs that are added by some of these requirements, I think, is bad. And so I think that's kind of what motivates at least some of the the arguments on either side. But like you said, some of the more blue states have embraced ESG-focused investment strategies, and others, the red states, have led this effort to limit or even prohibit those sorts of considerations. And there's the federal government, I think, will be slower just naturally, and so so I think it'll still be battled out on a state by state basis. And like you're mentioning, some companies have left some states for others, and in order to find a regime that might be more that's helpful for the particular business that the company is undertaking. But in California, like you mentioned, California's adopted disclosure regulations for corporations, and so they are, that's in contrast with states such as Texas, where they've, adopted sort of the opposite side. But Texas has passed a couple of bills that requires one, for example, the Texas controller to release a list of financial entities that boycott fossil fuels, fossil fuel companies, so oil and gas exploration or production companies. And so they have a list of companies that the state of Texas won't do business with. These are asset managers and banks for the most part. And then another Texas bill requires companies with say more than 10 employees, I believe, to indicate that they are not going to boycott or discriminate against fossil fuel or firearm companies during their contracts that they've entered into with state entities, and if those contracts have like $100,000 or more of value to them. So the state is taking steps as far as its own. So this doesn't apply to people other than the state itself. So the state is taking steps to manage the types of firms that it's doing business with. And Florida has a similar bill about investment of public money to promote ESG goals, and to prevent that with public money, or to prohibit ESG bond sales. And then states Kentucky, Oklahoma, Indiana, and others have anywhere along that kind of spectrum that they are focusing on. So I think these sorts of efforts will continue, and so money managers had best try to, I think, be cognizant of that. Again, investors are not monolithic; they don't all care the same. We've seen a lot of movement in Europe, especially where the European Commission and the Parliament have adopted regulations as to defining what's a "quote unquote" green industry versus a brown industry, and trying to direct capital from banks, insurance companies, and money managers into green versus brown industries. So that's quite a micromanagement by the government, and a lot of European investors and state sovereign wealth funds and that sort of thing are focused on those issues and actively telling their money managers that they want to have their money invested that way. The United States is a completely different environment where some, for example, state pension funds, union pension funds, they're invested that way. But then other, folks, even union pension funds, some are, coming from a more conservative investment, philosophy and are saying, no, we don't want to have, be discriminatory against, say, carbon, hydrocarbon type of energy companies. So it's quite a broad spectrum, but I think, that give and take is good. I think it's ultimately good for the marketplace. People have different strategies, and so the best money managers should be able to accommodate all of that.
So, Paul, finally, our favorite question. We call our podcast Next Round because we like nothing more here than to discuss public policy over a nice glass of California wine. So what wine or beer or cocktail are you drinking these days that's getting you through the hot, humid months in Washington that you could recommend to our listeners?
Oh, that's a great question. Well, I've been a gin and tonic drinker for ages, so there are lots of boutique gins that have come on the market over the last few years, which are really have lots of varying tastes and whatnot. So I think that's I recommend that. But then also the same with wines and. So right now I like there's an area in Austria called the Wachau area along the Danube where they produce some really incredible Rieslings and Gruner Veltliner wines, which are really delicious in the summer. And these are drier Rieslings than many people might think of when they think what a Riesling is. So I would definitely recommend trying some of those wines from that the Wachau area. It's a pretty area.
Thanks so much, Paul.
Well, thank you, Rowena. It's been a pleasure to chat.
If you like this episode, please tell your friends and subscribe to PRI's podcast at iTunes, Google Play, Stitcher, TuneIn, iHeartRadio, and Spotify. And when you're on these platforms, don't forget to give us a big 5 stars. If you don't subscribe to any of these, you can still listen on PRI's YouTube page, youtube.com/Pacific Research 1. That's the number 1. Thanks for listening. I'm Rowena Itchon. Hope you'll come back again for Next Round with PRI.